Hi there, it's Dan Kerr's DK Analytics. It is August 31st, 2018. We are coming back to you from our main Florida-based operation, location, if you will. And I'd like to just make a few short comments on our most recent post of 4 or 5 days ago, post 44, where we go into America's Q4 prospects. We touch on QT and the sustainability of Fed QT in light of the increasing implosions of emerging market bonds and currencies alike, which is feeding on itself. And then we go into the last man standing, the US dollar, and how the pressures that are increasing on the US dollar in terms of it being forced up in a world where dollar liquidity has been forced down by the Fed's QT efforts that are gaining speed and its 2-3 year campaign to nudge up interest rates. Now, we are full-fledged proponents of a real interest rate savings that are generated instead of by printing money, which brings with it a whole nasty side effect from financial repression or ruination of price discovery, the ability to transfer property rights from makers to takers, balkanization, illegal third world immigration, and productivity or capex, which is not the primary focus with which to drive future top and bottom line, but rather financial engineering. In the vernacular, stock buybacks, and then adding trillions, $3-4 trillion or more in debt in order to sustain this fiat currency Ponzi scheme, if you will. What has happened? And we readily admit that we are or remain in the dollar bear camp, and the dollar has been rising. We believe the reasons for it are not justified based upon the U.S. economy, politics, and finances. The U.S. economy, the 4.1% growth print, is likely due to revisions related to trade themselves, a byproduct. You've heard tons about soybeans and other products being exported out prior to the actual need for fear of trade tariffs being put in place, tit for tat across the world. And you've also heard of inventory build, and those things are not sustainable, especially not when you really don't have a consumer that has more income despite all the headlines. Reality is if that were true, consumer debt wouldn't be above 13.3 trillion, a new all-time record. And get this, until recently, U.S. Personal savings rate was plumbing all-time lows, 59-year lows. We talk about that in post 42 on QT in particular. And you know what? More sleight of hand here. The federal statisticians, the BEA, went and did the unbelievable now for the second time, because the personal savings rate was clocking along at near 59-year lows of between 2 and 3%. Hey, back in the 80s, it was about 12, above 10. But what they did was they changed definition, and presto magic, the savings rate and on retroactively as well has near doubled, which brings to mind, and I have this embedded in that post 42, the BEA's work in 14, where after the 07 personal savings definition rendered some unflattering negative savings rates or dissaving, they increased it by a factor of more than 2 to 1, and now they've been at it again. So You put enough lipstick on an ugly pig, and for a moment, she doesn't look ugly. And the same sleight of hand obviously has been going on in the heavily massaged and gimmicked GDP statistic, and by extension, the inflation statistic. I'm talking about the real GDP growth rate being way too high, and by extension, the inflation rate being much too low, and also, in a related fashion, productivity, which is abysmal, also being too high. So the dollar safe haven is not nearly as strong as the current Armageddon from Argentina to Venezuela to Brazil to Turkey to Iran. I mean, the real, the reals, the liras, and all these emerging market currencies in countries mentioned, others, are plummeting. And at the same time, interest rates are rising, and those economies are getting killed because the world automatically, reflectively goes back into the buck as a safe haven. But again, that safe haven status, I would argue, is not earned because, in fact, the United States is the biggest debtor the world has ever seen, period. And that's the on-balance sheet debt of over 21 trillion and growing by an excess of 1.2 or 1.3 trillion a year, which the Fed is going to exacerbate by throwing up to 600 billion of bonds, i.e. money that disappears from the system onto the market. And I think what is going to happen here is pressure will continue to build as these emerging market currencies fail and interest rates rise in terms of exposed Western banks, which have lent a lot of money. Think about this. There's some 900 billion in emerging market bonds coming due within the next year. There's something on the magnitude or on the order of $58 trillion in emerging market debt, nearly 250 trillion in global debt. And a lot of that emerging market debt has been dollar-based. So you got a 1-2, a double whammy. You've got dollar going up, makes repayment more difficult in local currency terms. Those countries had incorrectly bet on a lower dollar, which we must admit we also subscribe to, which is why we think this current situation is unsustainable. We're talking about the dollar strength. But a Fed that has been trying to institute financial rectitude into a system where a toxic public policy stew, his trade deals or the most recent reduction or the rearrangement with NAFTA or whatever they're going to call it, it's just going to busy a lot of bureaucrats in both countries to tally up, 30, 40,000 parts to make sure that, 75% of them are domestically sourced, that the Mexicans earn, some $16 an hour. And what this is it's micromanagement, more micromanagement by bureaucrats that will not reduce the corset that's on global trade and domestic the domestic economy, but it will increase it. And we aren't going to get litigation redress because Donald Trump is majored in stiffing contractors and then turning around and saying, so sue me. So the environment in the United States, and we touch on this in post 41, the good, the bad, and the ugly, which Zero Hedge thankfully picked up. The situation here is not conducive to sustainable economic growth and a resumption in productivity. It continues to be a hodgepodge of incentives that are either crony, that are aimed at redistribution, or that have the signature of an ever-increasing government ascribed to them. Said differently, you cannot reduce regulations and the impact of government if you're growing government to record levels. what Trump is doing. The two don't wash. You need to try to pull out entire departments and not increase the spending both on the discretionary and non-discretionary side. Social spending, welfare, and warfare, if you will, as Ron Paul likes to put it. So things here are not back despite the efforts of Donald Trump and overshadowed, frankly, by his absolute abandon of any fiscal rectitude which was promised. His abandonment of true reduction in immigration. The net growth of jobs in America have almost solely been awarded to immigrants, and most of those are illegal in nature over the past decade. So this isn't how you inflate or strengthen the growth rate or the runway of a domestic economy. You need to go back to basics, but those basics don't make for good sound bites. So where am I going with all this? The US dollar emperor wears no clothes. Yet at the current point in time, the emerging market currencies and bonds are getting fleeced. But if bonds at the end of the day are nothing but a reflection over time of the strength of a nation's solvency, its currency, then the US is the biggest drunkard on the planet in terms of being recklessly indebted beyond any stretch of the imagination, either domestically or vis-a-vis foreigners. It's a net debtor nation to the tune of over $8 trillion. So here's where I'm going with this. The current situation of the domino effect of emerging markets collapsing currency-wise, bond-wise. You've got currencies in South America, in Turkey and elsewhere, in the Middle East dropping by 20, 30, 40, 50%. You've got interest rates trying to maintain capital that go into the double digits and higher. This really is the prelude to a return to accommodation by the Federal Reserve. Why? Because the Fed is owned by its member banks. And those member banks and their balance sheets and their exposure to emerging market loans, developing country loans, it could very easily cause a hiccup if we add the heightened political uncertainty domestically here and internationally into the mix, whether it's the Middle East, whether domestically it's the red versus blue states, whether it's the widening chasm in Europe with Italy and Poland and other populist-oriented places wanting to break ranks with the globalists running the show. I think the pressure is on. And the financial pressure and the political pressure is amplified by the economic pressure, meaning we're in a record expansion, a fabricated, phony expansion, an overstated one, coaxed through the toxic public policies through straitjacket of regulatory, tax, and litigation insanity, and lacking parallel interests between the C-suite and the broader constituency in which they operate, that is, the nation states in which they were incorporated. This whole thing has got to come apart at the seams. And people always brush aside contagions. And in reality, if a large chunk of the emerging world is going to pull banks into the shitter, not to mention their exposure to potentially rising interest rates around the world, which is starting to bite outside of the buck or outside of the yen, outside of the euro, then it doesn't take much to cause a freezing up of interbank loans, heightened counterparty risks, and pretty soon, if things get out of control, unpayable exposures in terms of their bets on interest rates, the big banks, the money center banks' bets on interest rates staying low. Financial repression will continue to trump price discovery. Well, as we can see, that is being peeled back in the emerging world. And as I state again and again, we don't have reversion to the mean. We have reversion beyond the mean. We go from boom to bust valuations. The emerging nations are going to suck in the developed nations. Germany is considering bailing out Turkey because it's afraid of the contagion effect. So all the Main Street financial press telling you that this is going to be contained, remember back to 2008 and the US property market debacle, where all these supposedly AAA securitized mortgage-backed bonds came apart at the seams, and it nearly brought down UBS, the financial titan of Switzerland. And today, we have about $80 trillion more debt, $16 trillion more in terms of central balance sheets, central bank balance sheets, which have allowed for this huge increase in debt. So we've got greater monetary inflation risks. At the same time, we have much higher than 10 years ago debt-induced deflation risks. And the emerging markets are going to fall first. When this thing spreads to developed markets, not only the bank exposures, but sovereigns from Italy and elsewhere are going to get into potential trouble. So what will the Fed do? What will the Fed do? And it will do this primarily to protect, as I keep saying, its owners, which are money center banks. The Fed will do a big fat about face from an embryonic or perhaps somewhat established QT, that is destroying capital or money by taking bonds and selling them into the market without repurchasing them or extending them. And when it switches from QT to QE and opens up the monetary spigots either by balance sheet expansion and or with a move back to lower interest rates to try to keep this contagion from becoming a global tsunami instead of just an emerging market phenomenon, then the cat will be out of the bag that the entire 10 years of financial repression has brought with it. Not sustainable, productivity-led, self-financed economic growth, but rather just the opposite. That is the grapes of wrath, the results that come from our toxic public policy stew, enabled by the printing press, right? Regulatory, taxation, litigation insanity, reduction in property rights from the makers to the takers, to illegal aliens, to capital flight. And this whole thing, when this manifests and the Fed is forced into doing an about face, this will lay bare the absolute insanity of this Frankenstein finance that they've been undergoing, which is unprecedented in history. We've never, ever had interest rates like this. We've never, ever had global monetary printing like this. And in modern times, we've never had such crappy productivity numbers. And they're tied at the hip, these things, right? Because misallocations rule under financial repression. So what's the bottom line here? The bottom line is that the reset, which in my opinion, and I go into this in post 44, is how will stocks and bonds and real estate, and when I say stocks, also businesses, be valued against the true safe haven, which isn't government bonds, which isn't government bonds of so-called investment grade OECD nations, Germany, the US, Japan, no matter how stressed the latter two are, it's going to be how are assets valued in fiat currency terms against true money, namely extremely rare gold and silver. I know I sound like a broken record here, but I think time is of the essence. even as everyone cheers on unsustainable politics, finances, and economic policies, the nosebleed valuations in stocks and bonds in the US in particular, and in bonds most especially, obviously, in Japan and in Europe, where the interest rates are even lower. And by the way, those countries are going to be turning to quantitative tightening probably right about when the Fed throws in the towel on the same program, because you cannot get back to sane financial policy, monetary policy, without also getting back to free market capitalism, the rule of law, the property right protections, and other such boring stuff which underpins the wealth of nations, underpins the wealth of nations trajectory, right? You just can't. And that is the rub. That is the fly in the ointment. We think that's going to be on display sooner rather than later. And we continue to think that strategic investors have an enormous reallocation opportunity away from overvalued stocks, most especially bonds, even more so. And I'm referring to bonds and stocks that have been purchased relatively recently. In other words, at bubble valuations. If you are fortunate enough, lucky enough, wise enough to hold Johnson & Johnson and Nestle, or some other blue chip stocks or good growth companies that you purchased at a fraction of today's stock price, why then you've already locked in a very advantageous PE. You don't have to worry about the turbulence, and you likely have a really juicy dividend yield. So for those kind of people that have very long-term holdings where purchase prices of stocks were low, very low compared to today's earnings power dividends, where you've got dividend yields of 10, 12, 15, 18% or some such, those kind of people shouldn't move. But most people aren't that fortunate, and that's the community that I seek to address here. Enough said. For more details, please do have a look at post 44, and it ties in a hopefully useful fashion to prior posts and to data in case you want to check out the claims that I make. Thanks a lot for tuning in. I'm back in Florida, in Southwest Florida, after a couple months in Greater Zurich, Switzerland, a little bucolic place called Niederweningen, and I hope you get something out of this. And if you do, please help me spread the word. Thank you very much, and bye-bye.